Coming up today, stocks continue to rally, the latest numbers from Amazon, bearish sentiment builds, companies in the firing line, preview of the jobs report tomorrow, Uber bounces back, and the commodity that may be about to go vertical. I've got a good one for you today, guys. Let's go. And welcome back to Click Capital, everybody. What an amazing market we're in. Even though the indices finished a little soft here today, there's still plenty of action going on underneath the hood. In fact, my active trading account, which you're looking at now, is actually up over $16,000 on the day in my local currency. That's about $9,000 US. And that's thanks to some of the trades I've shared on this channel for free over the past few weeks. And stick with me today because I'll cover those trades again, along with some other hot stocks I'm currently watching that could potentially make big moves next. I'll also walk you through an options trade I took on AMD today, along with showing you the trade fill on my account and my plan for this trade going forward. I think you'll find that really interesting. And no, unlike plenty of others out there, this is not a paper trading account. This is just one of the 6 portfolios I actively manage for myself. And this is an account I like to be a bit more aggressive in, take a bit more risk, as I do have a high tolerance for volatility. And I do engage in writing puts. Recently been doing it in a stock like Moderna. But I'll get into all of this later on. For those of you who are new here, welcome. My name's Jared. I'm the founder of Click Capital. And before I started working and trading for myself, I was previously at a large investment bank in the Treasury department. My role involved managing large transactions for high net worth investors. I was trained in anti-money laundering, fraud detection, and how to spot scams, and how to tell if somebody is lying, as I had to protect the bank's risk. And trust me, when I watch some of the biggest financial YouTubers out there, alarm bells go off in my head. They're actually preying on new traders and the vulnerable, leading them into the same trading traps and rackets we've seen going on for years and years. So what you'll never see on this channel, you won't ever see me promote over-the-counter penny stocks, with those companies actually paying YouTubers to promote them, as the insiders have loaded up on the shares beforehand. So I've never taken any money to promote any stock, never have, never will. I also don't encourage day trading. Many studies have proven over 95% of retail day traders fail because you can't beat the algos at their own game. Between the spreads, commissions, being front-run by higher frequency algos, day trading is a game heavily stacked against you. That's why I focus on active swing trading and long-term investing, the methods that actually work for us retail traders. As many of you guys know, Tesla, one of my core long-term holdings, along with a few others I regularly talk about here on the channel. Another thing you'll never see me do is use the classic bait and switch trick where you're invited to a so-called free trading event that's really a sales pitch for a bucket shop broker. That's CFD and FX brokers. These brokers don't offer you access to the market. You're actually trading against the broker. And like I said, a lot of newbie traders don't even realize that. They're basically the online casinos of the trading world, profiting when you lose. So make sure you stay as far away from CFD brokers as possible and anybody who promotes them to you, as they're really just encouraging you to gamble for their own gains. And these bucket shop brokers, they pay these online gurus a cut out of your losses, which is why some YouTubers push them onto you. They'll also buy fake Google reviews that are easily proven and is actually illegal to do. They'll publish fake success stories on their site in order to create the false illusion of success. They talk a big game, but here's the truth. They're not real traders. I don't need to sell you bucket shops or promote day trading to survive. I trade every day, share my trades transparently, and help my audience build real knowledge. So if you want to follow someone who's actually trading and sharing trades daily, hit that subscribe button below this video and join me here on Click Capital. Every market day after close, I break down all the market action, sharing a few of my trades, and help you navigate the markets without all the shady tactics. So let's dive right into it, and I'll come back to my trading account later on in this video, and I'll show you my AMD trade today. First off, let's just go over the biggest headline hitting the wires after hours as I speak. We're just getting earnings from Amazon. And once again, the market is punishing these mega cap tech after hours, even though they came in with a pretty good beat there, 25% on earnings expectations. $1.86 a share. Stock's currently off 4.8% after hours as I speak, as apparently the market's a little underwhelmed by their outlook. However, I think the market's been quite harsh on these mega cap tech of late, and maybe justifiably so, given some headwinds they're currently facing. They're expecting for the first quarter revenue of between 151 and 155 billion, a little bit shy of the 158 analysts were looking for, but they did mention unusually large unfavorable impact from currency due to the strong dollar of late, lowering international income. But just stepping back and looking at their growth, not too bad. From their main business, online stores up 8% year over year. Pretty good, considering apparently we're on the verge of a recession. Third-party services up 9%. AWS, look at their cloud. Just like Microsoft, incredible. They're still getting healthy double-digit growth there, along with advertising and subscription. And just stepping back and looking at how their revenue flows into profits. Like I said, all categories up year over year. Even Whole Foods, 8%. Very healthy. Gross profit margin, 47% into a net profit of 20 billion. And the market had been running a little hot on Amazon the last few months. Has been holding up some of the best out of the pack, including Meta. And so we're currently trading around 227 after hours as I speak, which is right around the 50-day VWAP here, the yellow line on the chart. So it's kind of a similar reaction to their earnings like we saw in Apple and Microsoft last week as well. And Alphabet yesterday. The market kind of taking a bit of pause on mega cap tech. And even though guidance coming in a little shy of what the street had been hoping for. There's still really good growth. There's still such dominant businesses, huge margins. AI bull market is still intact and they're still set to hugely benefit from that. But just because the stock can have a negative reaction straight away on earnings doesn't always mean that the uptrend is lost. I've seen this time and time again. It's almost like a shakeout, which can actually offer up good opportunities. Like I was mentioning yesterday on Uber. After they got sold off after earnings, the numbers were still exceptional. In fact, they've been accelerating the last couple of years. Market was worried for a long time on Uber being cash flow negative. The consensus was they'll never get to profit. And I think those dark clouds are still hanging over the stock when it comes to investor sentiment. But gross bookings were up 21%. They dominate in moving not only people, but more and more goods around the economy. Not just food, but also getting into delivering pretty much anything. And like I said, management's really proven over the last 2 years that they can become immensely profitable. Like I said, for quite a few years, they were burning through cash. But that's what companies do that play the long game. Short-term pain for long-term gain. But look at the acceleration in cash flow up until the right ever since 2019. And like I said yesterday, the stock sold off on earnings, down 7.5%, starting to look like another classic gotcha by the market. Massive bearish to bullish flip here today, up 8.5% on strong volume as well. It's what we like to see in technical analysis. Just like we saw after their last earning, got a strong push up, actually led to a pretty good rally up in the stock. We then pulled back in late last year. I topped up my long-term position in the stock, and I still think it's fantastic value here going forward. And so this is a stock I plan on holding for many more years to come. And so you got to use volatility in the market to your advantage instead of being spooked out about it. I know there'll always be the fear brigade online calling for the apocalypse. On every little dip we get in the secular bull market, however, a lot of those dips prove to be great opportunities, especially one we saw on DeepSeek 2 Mondays ago. Really knocked over power stocks. There's apparently a $6 million knockoff coming out of China, topples the whole electricity thesis in the States. Another big secular trend that's going to play out over many years. And even though Trump is more pro-fossil fuels, definitely some headwinds there for the wind and solar industry. One area of clean energy that he's actually very pro is nuclear. So we got the tailwind from the US government here. And just like other industries, he wants to put America head and shoulders above the world. And so we should be expecting some positive headlines over the coming months to do with this, along with dialing back regulations to allow the industry to invest and advance. And obviously one of the hottest trades of Q4 last year going into Q1 this year, small modular reactors, SMRs. They're advanced nuclear reactors with the ability to provide around 1/3 of the generating capacity of traditional nuclear power reactors. They take up much less physical space and they can more easily be put together on site and custom made for the customer. That's why we got stocks with the ticker symbol itself, SMR, still holding on to this really strong uptrend that kicked off last year, and some others as well. Nano Nuclear, Oklo, really strong out of the gate this year, and on the more speculative side, Lightbridge. In addition to some more traditional electric utilities, Constellation, Bloom Energy, and one of the hottest stocks of last year, Vistra, still holding ground here. And so I agree with this article headline. It takes more than tariffs and DeepSeek to keep this stock market down in 2025. I think Trump will have more of a tolerance for volatility and pullback in his second term than he did in the first, because remember, he's not up for re-election this time around. And so I think the focus for him this time will be more about his legacy, actually trying to clean up a lot of America's issues. Federal debt, wasteful and corrupt spending all around the world that we're just hearing about. Absolutely mind-blowing. Some of the stuff that's coming out, really pulling back the kimono on the deep state, which of course they're not happy about. But anyway, back to the market. No doubt we're going to get little tantrums, spikes in fear. You just want to keep an eye on the things that matter. GDP growth, corporate earnings per share, analyst estimates, inflation, bond yields, all the stuff we cover every day here at Click Capital. And the good thing is, and this has pretty much been true this entire secular bull market, as there's never any shortage of bears out there. They'll run with the slightest headline, scream crash on the slightest pullback. We've actually had more bearish readings this year than we've had bullish. In fact, looking at the AAPL investment survey, we actually got the highest bearish reading we've seen in a year, 42.9%. Still plenty of bears out there who, just like they have been this entire bull market, constantly calling we're on the cusp of something big, it's about to go down, for none other reason than a particular indicator is really high or really low. Therefore, it must go back. But like one of the best investors ever, Peter Lynch once said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And that's a great quote, and it reminds me of another one. Bears sound smart, bulls make money. And no doubt, American stocks have been on a stellar run for many years now. But people just think because of that, it should come crashing back down to earth. But the thing is, there's so much money out there that needs to find a home, and there's actually good fundamental drivers for US exceptionalism and outperformance that doesn't look set to change anytime soon either. Looking at a table here of major global stock markets, America's had 20 years of earnings per share compounding at 6.6% per year. Not only is that significantly higher than the rest of the world, especially in percentage terms, it's over double of Germany's, but American shares payout ratio, in other words, how much can these companies return that created wealth to investors in the form of buybacks and dividends is truly exceptional when you combine that with the growth. And that's what gives a huge return on equity. And no doubt the higher PEs are justified. Now, of course, this may look different over the next 20 years. However, for the here and now, American mega cap tech simply dominate the world, and we live in a technology-driven world. First the internet, now AI and robotics, and that doesn't look set to change anytime soon. But again, we'll have our bouts of volatility and pullbacks like we do every year, in which the bears will say, look, I'm right, the market's down 10%. And so one of the biggest things driving a little volatility for the here and now is a trade war between America and China. More and more companies getting caught in the firing line. Calvin Klein, Tommy Hilfiger, just being placed on China's unreliable entities list, which could force them to shut down stores, cease manufacturing, and send employees home. So China, as expected, is showing a willingness to bite back, but proportionately. They did put 10% tariffs on a bunch of US imports, but at a far lower level than what Trump put on them, which he did 10% across the board. And so no doubt in the coming weeks and months, we're going to see more volatility as this plays out. Definitely could get worse before it gets better. And you want to be careful around retail stocks in particular. Those that import a lot of goods from China could definitely experience some sell-offs while they rejig their supply chains. But remember, the point of this is to incentivize domestic production and help entice America's largest trading partners into doing favorable deals. So for the here and now, it doesn't look like we're going to get a big trade deal. I think it might have to actually get worse before it gets better. Maybe Chinese and American markets have to feel a little bit of a pinch, and both sides might succumb to political and social pressure, especially in China, to get a deal done. But again, that just sets up for a massive rally in the market once these tariff storms get cleared out of the way, for which I believe some of the biggest winners could be Chinese stocks themselves. Alibaba could have a monster year if this doesn't turn into a full-blown global trade war that goes on for years. Hopefully not, but that is still definitely the risk, tail risk. But I'm optimistic that Trump and Xi can eventually come to the table and get a deal done. And Alibaba, which has also been making big inroads into AI, they just came out with a chatbot that on a lot of measures is right up there with the best of them, GPT, and even on some measures doing even better. We just heard today a world-class AI scientist joined Alibaba as vice president, Stephen Hui. And so at this stage, it's pretty much only the Chinese that can actually compete with the Americans when it comes to the most important industry of artificial intelligence. And there's a look at the daily on Baba. They just came out confirmed we'll get earnings on the 19th of this month. But so far out of the gate, 2025, I think it surprised a lot of people on its strength, as naturally a lot of people are expecting it to sell off given we're on the cusp of tariffs. However, the market was already discounting that coming into this year. So no doubt this is ever present on everybody's minds, likely will be for a few more months yet. We can see that on the mentions of tariff on earnings calls with CEOs. It's actually higher than back in 2018 because the tariffs are much more widespread and dialed up this time. Like I've been saying, Trump's playing hardball this time, and he has much more political support to do so. Another thing that could get markets moving tomorrow is a jobs report, like we get on the first Friday of every month. Expected to show growth 169,000, and new jobs created in January, unemployment rate 4.1%. And so even though last year we did see some signs of softening in the jobs market, everyone was screaming recession, emergency rate cut, Fed did actually do 50 basis points right in front of the election. Unemployment rate ticked up to 4.3, but then it's pulled back and it's somewhat stable. But we'll also be getting annual benchmark revisions tomorrow, and maybe we get a little surprise on that. Jobs market may not have been as strong as it has been over the last year. Maybe the Bureau of Labor Statistics will do some massive downward revisions like they did last year. And if so, that could get bond yields moving around, along with a pickup in volatility like we quite often see on Friday afternoons. Going into the weekend, as a lot of people like to bail before the weekend. And it's interesting just looking at this chart, got record levels of bearishness on long duration US Treasuries, looking at the short interest in the popular bond ETF TLT. And so the common mistake people make when they see a chart like this is automatically to think to go the other way for none other reason than it's a record high. Therefore, that means TLT is about to rally because there's so much money bearish on it. However, that's not always the case, especially in bonds. The market's a lot more sophisticated compared to equities. And again, it just reminds me of a famous quote, this time from Warren Buffett. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. And that's so true. I know I like to take a lot of contrarian trades, but I try and back that up with a fundamental thesis and valuation. Not just because so much of the crowd has gone one way. And just zooming in on this chart, it actually shows that it's not a contrarian signal. It's actually a confirmation signal. Starting here in 03 into 04 into the start of 05, short interest went up and peaked. There we are into 05. Short interest was peaking. Market actually rolled over back down to lows in 06. Again there in 07 and 08, short interest peaking again. But so did TLT late in 2008. Really shot up there in the GFC as yields got created. But then came right back down in 09. Short bonds in 09 was actually a good trade. Then again into 2014, we got another peak in short interest in TLT. Again, into this move here. Looks like big funds actually fading it. Didn't really fall off, but did consolidate for a few years. Just like short interest, and it really shot up into late 21, which was actually a fantastic time to short bonds. In mid-20, going into 21, even when it pulled back. And that's because the bond market went into a historic bear market, which is still in actually. So again, looking at the short interest on TLT, it's not actually a contrarian signal, it's actually a confirmation signal. And so maybe this huge short interest in TLT here, even though bonds are still being whacked, could still mean at least they're going to consolidate for a while, which I think is likely to be the case as well. I think we're probably closer to the bottom than the top in the bond bear market. However, for bonds to really rally, we need to see yields collapse. It's that simple. And for yields to collapse, we either need the economy to collapse or inflation. And again, anything's possible, but for the here and now, we're just not seeing signs of that. There's next to no financial stress in the markets. Volatility's low. GDP, EPS is growing. And if anything, I think there's upside risks to inflation, like the market's actually been pricing in these last few months. And if that's the case, yields could very well push higher. We could easily go into the 5s on the 10-year this year, and that would put a lot of pressure on TLT. Just like when the 10-year shot up in 21-22, Fed had to increase rates, TLT did the polar opposite, got absolutely created. And what also is going to play into that is oil. This commodity has the biggest impact on inflation out of all the others. Trump really wants it lower, wants to increase production, see what happens with OPEC, the Saudis, who knows, may even get a deal done with Russia. We did see the Biden admin release a lot of oil from the Strategic Petroleum Reserve. But as always, there's just such big forces at play here. Like if China can get back growth, that should help crude find a floor. But geopolitical tensions getting dialed down is definitely helping. And again, like bond yields, this may just continue bumping around, consolidating in a big range this year as well. But I also wouldn't be surprised to see it take out this support at some point either. And so that'll be good for inflation and may actually help accelerate economic growth, not just in the States, but around the world. And we'll just have to wait and see what happens with Iran. Like Trump showed in his first term, he's not afraid to take a hard line with them. Actually took out their top military commander with a drone. Said he's looking to put maximum economic pressure on them instead of paying them hundreds of billions of dollars and asking nicely not to build a nuclear weapon, that they then funnel those funds into their proxy groups. There'll clearly be a different approach used here. And who knows, we can't rule out the possibility of a little bit of a military showdown with Iran either, which again could cause some volatility in the short term in oil, maybe in equity markets as well. But we continue to have a strong bids in the market for gold. Central banks gobbling it up. Also, I'd say investors hedging their portfolios with gold, just like I have been, instead of the traditional treasuries. For a long, long time, the flight to safety trade was long-dated treasuries. However, I think that's changed over the last couple of years. More gold now, not to mention a huge opportunity in gold miners on a valuation basis. So I think we'll be able to find some refuge there. However, just looking at silver today, been hearing reports, the borrowing fee on the silver ETF has just gone vertical. That is the cost to short shares, pay an annual rate. Currently looking around 10.5%, pretty expensive for a normally liquid ETF. Also been hearing reports recently of 33 million ounces of real silver just got withdrawn from the SLV vaults. Somebody looking to take a lot of physical silver into their custody. And we've just heard the Chicago Mercantile Exchange, CME, raising their margin rates on gold and silver. Something else interesting I noticed is the put call skew on SLV spiking to a yearly high today. For those of you who don't know, this just measures the implied volatility of 25 delta puts versus 25 delta calls. And typically in commodities, out of the money calls are higher valued, a higher implied volatility, IV, than puts, because commodities are vulnerable for upside spikes more so than downside spikes. So when the put call skew is negative, that means the IV on calls is a lot more than puts. However, that's flipped now. We've got puts more expensive than calls. And that's the opposite of what you see in the equity market. Out of the money puts are typically more expensive than the same delta out of the money calls, as stock markets are vulnerable to downside spikes. And it wasn't always like that actually. Prior to the Black Monday, 19th of October 1987, Dow Jones Industrial fell 20% in one day. Puts and calls had equal skew. Option dealers would mark out of the money puts at the same IV as the equivalent out of the money calls. However, after that day, it changed the options market forever. That's why S&P 500 NASDAQ options will typically have a positive call skew, like we can see in this chart here. Even though volatility is still really low, 25 delta puts on SPY 14.1 versus 25 delta calls 10.5. And there's that spike on the 5th of August last year when put IV went up to 34. Calls were only at 20. So anyway, what to make of all this for silver? Does appear to be shaping up on the chart here, getting a lot of activity. Bullish seasonality, pushing up against my bands. Are we about to see a huge short squeeze? There's a lot of people betting against silver, and it is still technically in a bull market. Still got a bit of catching up to do to gold though. Nowhere near new all-time highs, especially adjusting for inflation. This will probably have to go to $70 or so an ounce, be at an inflation-adjusted high. And so you definitely want to pay attention to some silver miners like Fortuna, FSM, starting to shape up. There's Pan American just sitting up there, and Wheaton Precious Metals pushing up to highs as well. Keeping an eye on the silver market going forward and see how this unfolds. Okay, just moving on. As promised earlier in this video, I'm going to share with you the stock driving a lot of the gains in my active trading account today. Richtech Robotics, ticker symbol RR. Stock I first mentioned to you guys a couple of weeks ago, having a nice pop up there today. As we just got news from them, they're announcing the grand opening of Clofi & Tea in Las Vegas. That's where they're headquartered. And so this is their first store of their Clofi & Tea brand that's centered around its AI-powered robot, Adam. Serving as a barista, their store will be offering a wide variety of milk teas, coffees, and desserts. Utilizing NVIDIA's AI technology, Adam will detect when customers are present, engage them in conversation, take orders verbally, monitor and adapt to changes in his environment, and craft beverages with high levels of precision and accuracy. And so they're kind of a leader in this field. I first saw it with Jensen Huang, NVIDIA's CEO, actually, at an event. One of Richtech's robots actually served them a drink. I saw the Richtech Robotics brand on the side of it, which prompted me to investigate the company and do some research, and I really liked what I saw, not only for just in the hospitality industry, but in other industries as well. Like, for example, mechanics are using their robots to deliver parts around the shop so they don't have to constantly go and get them. They got the first commercially deployed humanoid AI robot in the US. And like I said, not just for hospitality and moving parts around, but also for cleaning. And like I said, this is still just the early days of a long secular trend of robotics, now powered by AI. It's not hard to build the hardware of robotics. It's the robots understanding and interacting in their environments. That's the hard thing. And so any advances, like we've heard with DeepSeek, or anything that makes AI cheaper or more can be done with existing chips, is just great for robots. And that's why I'm really excited about this company and plan on staying invested in it for some time yet. It's one of my more larger positions in a small speculative stock. And just keep in mind, it does have huge volatility. We're going to see big swings up and down in this stock for a long time. As a quick reminder, all my content is not financial advice. I'm just sharing with you my opinions, my research and my positions, and why I'm a believer in robotics. I think it's the future. I think it's inevitable. On top of market sentiment warming up for this sector as well. Hasn't quite had the run that we've seen in other sectors yet, like quantum and nuclear, but this is definitely the type of stuff that can get investors excited, award it a premium valuation, and just like we've seen with Tesla, that can actually help it succeed as well. And speaking of Tesla, I hear all the time, oh, it's just a car company. How can it trade on 100 times earnings? Ah, crazy. It's a bubble. Should trade at 20 times earnings. Well, if Tesla's just a car company, why are they advertising so many roles in their Tesla bot department? Well, the answer to that is they're ramping production of these guys here, the Optimus bot. Going to start selling them soon, $20,000 a unit. This is going to be so consequential, not only for consumers, but for businesses. Used in manufacturing plants and lots of different applications. Humanoids are a real thing. I think it's a lot sooner than what most people realize. And so again, Tesla's one of those stocks people love to hate, but I continue to believe it is destined to be the largest company in the world and eventually stand head and shoulders above everything else, because they're leading on possibly the biggest revolution of our lifetimes, robots, which will eventually overtake their electric vehicle business. And let's not forget about their energy and storage businesses either. So I'd relish the chance for the stock to come under 300 this year, which I will no doubt buy the dip on that as well. Add a few more shares to my long-term position, as I haven't added any since the low 200s after they unveiled Cybercab last year. Now just moving on to the other stock that's been copping a bit of hate in the market lately. In fact, there's a bit of a consensus building out there online. I can see people starting to call it the advanced money destroyer, AMD. This is exactly the signals I look for to show when bearish sentiment may be nearing a peak. And we are building volume at the lows, which is a pattern I've seen many times. In fact, one of the most memorable being Tesla itself, right back when I started this channel in early January 2023. And if we just scroll all the way back then, it was here. Big volume coming in down the lows. Well, the market just kind of churns sideways there. And so all that activity often coincides with peak sentiment, like we did have coming into 2023. I remember people were calling for Tesla $50 all over the place, with all their brilliant technical theories as to why, but the stock just kind of grinded and it turned out to be massive accumulation. You can go back and watch my videos from when I started this channel in early mid-January 2023. I was making a strong argument to why I thought that could be a bottom. Not only my technical indicators were showing clear signs of a big accumulation, but also my stock fair value indicator. If you look down here, as I hover over each day, it shows you my stock fair value. Had it at $184 while the stock bottomed out at 101. Like I said, all that volume down there on the bottom was indicating to me it could very well be a bottom. And just like I said back then, I was buying the dip. And here we are 2 years later, it's almost done a 4x since then. People still hating it just as much as ever. I love to see it. But anyway, I digress. Getting back to AMD, the so-called advanced money destroyer. Maybe at the start of a similar pattern, stock has come off quite a lot. Best valuation it's been at in years. Data center revenue still growing over 90% year over year. AI bull still intact. No doubt they won't be overtaking NVIDIA anytime soon. However, I still think they're a key player in chips going forward. And just to be clear, I'm not definitely saying it's the bottom, or that my trade on this will definitely work out. This is just another trade of mine. People get so hung up on an individual trade. AMD could very well go lower, which if it did, and nothing drastic or surprising's happened, I'll most likely sell another put in the 90s and may hold the stock for the rest of the year even longer if a good trend develops. So again, I'm not saying this is definitely the bottom. I'm just saying I'm seeing signs of a bottom, signs of peak bearish sentiment, juicy puts to write cash secured puts on. And so it could very well go down tomorrow, next week, whatever. I always get clowns and trolls saying like, you got wrecked, man, you're wrong. What a clown. Because the stock went down the next day after I said I've taken a bullish position on it. Like I said, I'm not a day trader. I'm not trying to take $2 out of a stock. That's ridiculous. Actually a bit of a joke just trying to hold a stock for a few minutes. Because those traders just fixated on the noise. They don't actually understand the fundamental drivers of the stock and the market. But anyway, like I was telling you guys yesterday, I was looking at the puts on the 110 strike expiring this month, regular OPEX on the 21st. And so they were at 250 yesterday. I put a limit order in, as I often do. Wait for the market to come to me. And so actually got filled at $3 today. And like I said, just starting off with one contract, which if the stock gets put to me, will mean 100 shares at a price of 110, meaning $11,000 notional. And like I said, if we go down to the 90s, I very well may sell another put, potentially up to 3, as I don't think I'll go much over 30,000 with exposure to this stock. Like I said, I like to make a lot of small trades and a very diversified portfolio. And that's part of why my portfolio is up big today. A lot of puts I've been selling lately have just been melting along with some hot stocks ripping. So I'm short the 110 put expiring this month at $3. So if I get put the stock, my effective cost will be 107. That is if AMD closes under 110 on the third Friday of this month, the 21st, regular OPEX. Otherwise, if it doesn't, that $300 is mine to keep, which I'll be keeping it anyway. Once I sell premium, I don't give it back. That's my premium. And so if it does close above 110 come the 21st of this month, I'll reassess then and I may write another put. Just keep writing puts on it, collecting premium. Remember, for each put you sell, you're obliged to buy 100 shares at that strike price if the stock's underneath that strike at expiry. So that's $300 US in premium. And so let's say it closes 107, 105, whatever on the 21st of this month. I'll get put the stock in my account, and then what I'll look to be doing is simply just hold it. I don't write calls on it straight away like a lot of guys that do the wheel strategy. I like to wait for the stock to have a decent bounce, at least in the short term. Maybe come up to my buy sell band, overbought in the DSI or whatever. But I think it's good valuation. It could be a good hold for the rest of the year. Maybe an asymmetric bet. That's not to say it won't turn out to be a loss. Of course, I, like every trader, have losses as well. So it very well could keep going into the 90s, 80s. Who knows? Anything could happen. But like I said, I'll play it as it comes. But ideally for this trade, it does form a bottom, even though it's likely to be messy, take a few weeks, month or two. And hopefully after this long downtrend, we can get back to a nice uptrend, maybe come back to 150, up to this resistance zone 170 or so, if I really do want to hold it for longer. Otherwise, if the market changes or something else changes, I see better opportunities, I may just turn it into a short-term trade and start writing covered calls on it, 120, 130 or so. Like I said, I don't know exactly when I plan on exiting it. I just do plan on holding it for a bit to see if we can form a bottom here. Then I'll eventually wheel out of the stock by writing covered calls on it. And I'll keep writing calls until the stock gets called away from my account when the stock expires above my strike price. So like I said, if you haven't already, subscribe to this channel, click capital, and I'll keep you updated on how this trade goes, good or bad. Even if I do end up getting out of it at a loss, I'll be honest and report to you guys exactly how this trade has panned out. Of course, a lot depends how the entire sector trades. No doubt we're going to see some volatility in chips for a while with this whole China thing. But like I pointed out yesterday, AMD is already deeply oversold versus the sector, and I'm getting signs there we may potentially be at a bottom as well. So I'm not even looking for the whole sector to rally. I'm just looking for AMD to come back to a bit more of an average price with the sector. And like I said, I think it's an asymmetric bet. I think there's more upside than downside for me on this trade. But again, I'm not guaranteeing it's going to work out. I'm not guaranteeing it's going to go up tomorrow in price, nor next week. As a lot of you guys know, I'm happy to hold my trades for a few months, even longer. So stick with me and we'll see how this plays out. Now let's move on to some other hot stocks that I've currently been watching of late. SkyX Platforms, another small cap, 210 million market cap. And there's a look at their website. A new smart, safe electrical standard for ceilings, Sky Outlet and the Sky Plug. So you find this with companies that have got their own technology, their own IP, patents, that gives them the pricing power, and markets can really get excited about them, especially when animal spirits are flowing, like this market is. New technologies with a lot of potential can often get awarded with premium valuations, especially when you have that positive momentum and news, any new contracts, new developments, new partnerships, new investors. And just technically speaking, I mean, look at this chart, still only $2 a share. So this is one I've got my eye on, along with others like Innoviz Technologies, Precigen, Life Sciences, and Synthetic Biology, really heating up here. Along with Amprius Technologies, another low-priced small-cap stock with a lot of potential, and other robotic stocks also involved in AI, Paladine AI, and another one I'm long, I actually gave you guys a week and a half ago, Record Systems. It's having a great week as well. But I've gone a little little bit into OT here today, guys. Had a lot to cover. Market was basically flat there today, with VIX continuing to pull back, 15.49. With the one day only at 15.7, option dealers not pricing in too much movement for the jobs report tomorrow. They're mostly right most of the time, however, not always, so we still could get a surprise tomorrow. Like I said, quite often Friday afternoons can get a bit spicy. Other than that, we still make our way through earnings, and just looking at Amazon after hours just before I wrap up, currently down 4%. So it looks like we're going to gap down on Amazon tomorrow, potentially somewhere around 229, which is only the 50-day VWAP. Like I said, we're seeing similar things on Microsoft, Apple, and Alphabet Google. Mega cap tech having a few pullbacks after their earnings. Bar Meta though, the strongest of the pack. Otherwise, that's a wrap for today, guys. Thanks very much for sticking with Click Capital, and I look forward to seeing you again this time tomorrow. Cheers.